So you've probably been hearing a lot about what happened at Silicon Valley Bank, and that's not what this video is about. What this video is about is really what can we as individuals learn from the Silicon Valley Bank. And I want to use it to illustrate a really important investment concept. Basically, what hurt Silicon Valley Bank was the type of bonds that they were invested in, the types of treasuries, and what can we learn from their mistake. And what happened with Silicon Valley Bank is they ended up having longer duration treasuries in their portfolio. And what happened, duration is just time. So like a short duration might be 6 months or 3 months or a year or 3 years. But theirs were longer dated. They were not coming mature for 5 years or around that, right? There's information coming out every day on this, but that's the general chatter on it now. And, you know, the challenge with a 5-year bond is, if interest rates rise quite a bit, which they have over the last 12 months. In fact, as I record this, it's almost exactly the first anniversary of the Federal Reserve starting to raise rates. So let's say interest rates rise by, I'm just going to say 1 percentage point. Obviously, it's been a lot more than that that's happened over the last 12 months. But, if you have a bond that's coming due in 6 months, that's not going to hurt you that much. You just hold on to it. It's going to mature. And even if you decide you have to sell that, people are only foregoing a lower interest rate, right? Your bond now has a lower interest rate than what people could buy in the market. So they're going to give it a little bit of a discount, right? Would you buy a bond at 3% if you currently could get 4%, right? You'd prefer the 4% bond. But if the other person said, let's say it's coming due in a year, well, I'll cut the price of my bond by, a little over 1%, then you'd be better off with that person's bond. So that's how that works. And so Silicon Valley Bank, as sophisticated as they are, made the mistake of unfortunately having bonds that had a longer maturity date. And so when interest rates started going up, they got hurt. They reported a loss of, and these are all general numbers, of about just under $2 billion. I believe the number was actually $1.8 billion. And because of that, they had to raise money, and that spooked the markets. And then a bunch of their clients started taking their deposits out. In fact, they lost about 25% of their deposits in a one-day period, which is just enormous. So that's how they got in trouble. But the important thing I want to share with you is, when somebody says I've got, 60-40 portfolio is really common. Just because you're 60-40 stocks and bonds, not all bonds are created equal, right? First, you have what's called creditor risk. And the creditor risk is, like in Silicon Valley's case, they had no creditor risk. It was the U.S. government. So what is the likelihood that this company or this government is going to pay you back your money? And when it comes to the United States, the likelihood you're going to get paid back your money is very high, right? Because worst case is the government, unfortunately, is just going to print money to pay you back. So you will get that money back. But just because it's from the government doesn't mean that it's risk-free. There's other types of risk, and this is a critical lesson. There's other types of risk, both with bonds and other tools. People will say in the stock market, well, this doesn't have what's called beta, a measure of volatility, beta risk, and so it's not risky. Well, that's not true. There's all kinds of risks that can take place. A classic example of that might have been, if 10 years ago you had gone short, if you had said, I think the price of Tesla is going to go down, if you had bought short Tesla and gone long Ford, so you were saying, I think Ford's price is going to go up, but Tesla's price is going to go down. Technically, if you have the same amount of money in each position, technically you have no exposure to the auto industry. But that's just one risk. And you could build that portfolio in such a way where, technically you've taken what's called the beta, the volatility, the measure of volatility versus the S&P 500. You've taken that risk out of your portfolio, but again, it doesn't mean you're risk-free. Same thing with bonds, right? 60/40, it doesn't mean that those bonds are going to buffer your volatility. And in fact, just last year in 2022 is a classic example. Stocks were down about 18% and bonds were down about the same amount as the stock market. And so both the stock market and bonds got hurt, and investors did not benefit from this diversification, from having stocks and bonds, because both were down. The reason bonds were down is because interest rates rose so quickly. So it's really important that you look at your portfolio from a risk management standpoint. And actually, interestingly, the early reports are that Silicon Valley Bank's risk manager left in April of 2022, and they didn't get a new risk manager until January of 2023. And as the name implies, a risk manager's job at a bank is to look at things like this, because if you're not careful, like in this case, a lot of people are saying they should have hedged their interest rate risk. Most banks would have done that, so they would be less susceptible to fast movements in interest rates. And that's what a risk manager's job is. And you know what? For your portfolio, you're the risk manager, so you have to look at this. And the main takeaway for most of us Main Street investors is bonds, and looking at bonds and what are the risk factors in bonds. So I said earlier that there's creditor risk. Then there's also duration, and just duration risk sounds like a really big word, big phrase. But just like the duration of a flight, right? Going from let's say San Francisco to San Diego is a 1 hour flight, or 1.5 hour flight. But San Francisco to New York City is probably a 3 hour flight, right? So the 3 hour flight has a longer duration. It's the same thing with bonds. So let's say you take a really solid company, a company like Walmart. Is Walmart going to be in business 100 years from now? I don't know. But is Walmart going to be in business in 3 years? When maybe if you own a 3-year bond, are they going to be able to pay back that 3-year bond in 3 years? I would say there's an extremely high likelihood they're going to be able to do that. So that's low creditor risk outside of the U.S. government, right? Walmart can't legally start printing money. They've got a heck of a business, but it's not that good. So if I had a 100-year bond, I don't think you could buy that, but just for the sake of argument, the creditor risk would be quite a bit higher. And of course, the duration risk would be quite a bit higher as well. So that is how that works. So there's creditor risk. I talked about duration risk. And if you really want to protect your portfolio from volatility, I think you have to look at high quality, short duration bonds, right? And the less risk that you want with your bonds, the less risk you take on the creditor side and the less risk that you take on the duration side. You make those bonds shorter, maybe 1 year, 2 years. If you're willing to take a little more risk in the bond sides, 3, 4, 5. Because interest rates were so low for so long, people were stretching for yield, including Silicon Valley Bank, by holding these longer duration bonds. And in our portfolios, in normal people's portfolios, not institutional portfolios, not corporation portfolios, for most individuals, for retirees, I think you're better off looking at the bonds for stability and then taking the risk on the equity side. Because certainly for a long time now, when interest rates were low, up until about a year ago, in my opinion, bonds were, particularly longer duration bonds, were all risk with no return. And people were amping up the risk in order to tweak out just a little bit of return. I mean, people were buying 10-year treasuries, 30-year treasuries at very low rates. And yes, they had no issuer risk, but they did have this duration risk. And the thing is, why were people doing it? Well, they were doing it because they couldn't imagine a world where interest rates would rise that dramatically and inflation would rise that dramatically. And you know what? weird things happen, and they happen all the time. So you have to be careful. The Silicon Valley Bank example. During the financial crisis, there was a bank that had a bank run and had to be taken in, had to be sold. And if it hadn't been sold, it would have been taken into receivership from the Federal Reserve. During that crisis, Washington Mutual lost just under $20 billion in deposits. So they didn't lose, people took their money out over an extended period. But what happened with Silicon Valley Bank is they lost a fourth of their deposits, just over $40 billion in one 24-hour period. And if you had asked bankers if something like that could happen, a lot of them would have said no. I mean, that's just a huge amount of money. But, if you look, Silicon Valley Bank kind of lends to tech companies, venture capital-backed companies, and that's a very tight community. So, the joke is this is the first bank run that was caused, that was driven by Slack. Slack is a communication tool that a lot of tech executives use. So that's the joke on Wall Street, was it began because of Slack. Clearly that played a role, but it's just said in jest. But anyways, I hope you found today's video helpful, informative. If you did, do me a favor, leave a like. It really does help the channel grow. And leave a comment. I love reading the comments. So until next time, I'm Azul, encouraging you to take full advantage of the youth of your senior years. Remember, you're only young once. Use this time wisely.